They're in the what's it called?
Can you go on? I just shared it with you. Can you go on YouTube and make sure it's there?
Okay.
I get some.
I'll do audio as backup just in case.
Oh, thanks. Addicted. I haven't seen one of those in a while. When I was a kid, I used to record freestyles on that.
Really?
Freestyle.
Yeah,
I'd like literally be in the kitchen like making some salsa.
Where?
some culinary freestyles.
There are a lot of culinary freestyles. Not kidding.
Pesto is pesto.
See, a 7-year-old me was not that clever. No.
How did you send this to me?
I shared you on it.
On Slack? Oh, wow.
Video editor, live streaming enable.
It doesn't feel manual, I guess. This isn't even you.
Video streaming. Get started. I agree. He's not on this call. It's really worrying me. Good. Where are you?
I'm not sure I can.
Unlock your sweat. Now I know the school was yesterday. Notification. What plugin is that?
Yes, where? It helps me see when people open my emails.
Oh, I should get that. Does it have inbox integration? Because I see you're using the like.
Yeah, I'm actually.
Yeah,
Yeah,
so-
I'm not. I don't know if it
As
works.
long as you're broadcasting 30 minutes afterwards, it should be.
On YouTube.
Yeah.
When are they gonna present? When's the
When?
Yeah, when's the talk?
As soon as people get here, I mean, it should be starting.
I thought it was 6:30.
Yeah.
Well, okay.
She's like,
All right, have you figured it out?
Yes, I think we did.
Right.
Awesome. It says it's streaming, so let's hope that that's working. We can get started. We don't have a lot of people right now, but I'm assuming they're going to be trickling in. It's not such good weather out there, and it's kind of a trek to shift. So we can just sort of get started.
Okay. So, since we didn't really chat ahead of time, what you wanted to prepare, I need a little guidance.
Sure.
You know, there's the deck that I used at Hack NY, which I modified for Shift. I'm happy to kind of pull that up and share it on the screen.
Yeah, that'd be great. I know that Abril really enjoyed your talk at Hack NY, and I think that she wanted sort of something along the same lines for Shift that would be useful. So whatever you have is great, I'm sure.
Okay, so hold on for one.
Definitely.
Let me give me a moment. Okay. So if we come here. All right, now I have the drawback of you guys can see me, but I can't see you.
You can't see us?
No, because my full screen is taken up. Can you see me still?
I can see your slides.
Okay, you can see the slides, but you don't see me. Okay, great.
Yep.
All right, should we get started?
Yeah, let's do it.
Great. So, hello everyone. Welcome to crappy weather. It's pretty bad in New York as well. My name is David Aronoff, and I'm a partner at Flybridge. We're an early stage tech investor with offices in New York and Boston, and I run the New York office. And this presentation is kind of an overview of the venture capital business. And so it's meant to be a primer. It's pretty long, and I don't plan on going through every slide, but we can certainly stop if you have questions on different aspects. If you want to speed me up, because I can't see you right now because I'm looking at the same screen you are.
Yeah, sure.
Feel free to just yell, go forward, or if you have a question, use your voice instead of raising your hand, and we can stop. So it's your time, and we can take it any way that you want to go.
Yeah, sounds great. Thank you.
All right. So we can actually get this going. So, you know, this is for those of you, hopefully all of you have seen Silicon Valley, and this is kind of the an iconic scene. Let's see if the video plays. Will it play through the whole thing? I may not be able to get video going through this.
I don't think
It's spinning for me too, so if it's spinning for you guys, let me see if I can get out of it. How about that? We're not going to have video. Let's see. We're going to skip video because that doesn't seem to be working, which is unfortunate because I had some good video. So hold on a second. Hold on. All right. So this was going to be a very funny video from the HBO series Silicon Valley, where they talked about the notion of rebillionizing, which is actually not the way that, if you watch that on TV, it's actually not exactly the way venture capital works, although there is some truth to a lot of it. What I plan on doing tonight is taking you through a little bit of my background to give you context, an overview of the history of venture capital, a section on pitching to venture capitalists and kind of what we look for. We probably won't have time, and I have to dig up on my computer. This works less well remotely, but if you're interested, we can go through an analysis of a term sheet. I can certainly, even remotely, just talk you through kind of the major sections, and you know, both from a venture capitalist point of view as well as an entrepreneur's point of view, what to think about with a term sheet, and then Q&A. I'd love it to be kind of in situ as we go along. All right, so my background, I have a BS in computer science from University of Vermont. I started a newspaper and magazine subscription business with a bunch of friends. Actually, I was not the founder of the company, but part of the startup group, and that was, you know, essentially a way to make beer money during college. My first job out of college, I went to AT&T Bell Labs, which really no longer exists. And at the time, it was one of the preeminent kind of commercial research labs in the country. And you know, the group that I worked for was doing network routing and security software. And this is in the late 80s. And a lot of the concepts we were working on back then were things that have kind of hit the forefront really in the past decade, things that you'd be familiar with. And we were doing it for government agencies, and I can't tell you the names or the businesses of it, or else they'll come after me. I stayed there for about 3 years. In the midst of those 3 years, they sent me back to get my master's in computer engineering. I went to USC and found that I loved the program, but I hated LA, and so I came back as quickly as I could and rejoined the labs. And then I left about a year and a half after I finished my master's and joined a venture capital-backed startup that was developing networking systems, and I was hired to be a routing architect. And at that point, venture capital was a cottage industry in the US, and no one really knew what a venture capitalist was. The industry, and I'll talk about some of the details kind of around that time, was relatively small. Venture capitalists didn't invest in kind of ground zero startups. They invested largely in companies that had shown some progress, that had been bootstrapped or funded by friends and family. And in the case of Chipcom, this was a company that had had a previous life, but then they got into this networking business when that was really first conceived, and we took it to, from 0 to 350 million in 6.5 years. I got there were about 65 or 70 employees. I left, there were over 1,100. We took it public and eventually were acquired for $1 billion by 3Com. The year we did 300 million of revenue. And so for those of you keeping score of what goes on in the public markets today, if you had a highly profitable, 12 quarters in a row of profit or so company that had only raised 6 million of capital, spent 3 million of it, and built a $300 million business, it would be acquired today for a lot more than $1 billion. I left to go back to business school in '94, and you'll notice in the overlapping years there, I actually continued to work at Chipcom through my first year in business school, which was possibly one of the dumbest things that I did in my career. The first year at HBS was brutal. The first semester was brutal. We just had our first baby, and I was up all night trying to keep up with the homework, and also because I had a screaming baby. In between years, some really rich guys found me and put me together with another guy they found who had a background in technology, and they gave us some seed capital to go find, this internet thing was becoming commercial, and they told us to go find a good business to start on the internet. So we went out, we tried a bunch of different ideas, and the idea that we centered on was basically being the Yahoo for internet games back in the day. And we founded a company called HappyPuppy.com. The URL was owned by 3 people who lived in the basement of one of the 3 friends in their mom's home in Issaquah, Washington. And with those 3 people, we started the company, which became the #1 game site on the internet, and was that way for about the first 5 or 6 years of the commercial internet. We sold it to the Globe.com, and you guys are all too young, most likely, to know the Globe.com. You can think of it as Facebook, beta version. And it was a social network, before we called them social networks, largely focused on college students. There's another epic story that goes with that, which is get a good lawyer. We had a lawyer from kind of a local lawyer where my partner lived in Naples, Florida, and the other side had very sophisticated New York lawyers. And so we learned the difficulty of signing very stringent agreements. I didn't believe in the business as much as my partner did, so upon graduation, I continued to be an advisor. I let him go with it, and I joined Greylock, who had recruited me out of HBS. And Greylock, for those of you who don't know, is kind of one of the preeminent venture firms, have been that way for over 50 years now. And I stayed there for almost 10 years. I started as an associate. I was promoted to a partner after 3 years. And over the time there, I made about 18 investments, had 15 acquisitions, 1 IPO, and a couple of companies shut down. I got there before the first internet bubble hit. I helped pump it up. And then when it burst in 2000, 2001, I had to deal with the aftermath, which, to be honest, was a much richer learning experience than the first 5 years in venture. I left in 2005 to join the other young guy in the Boston office at Greylock. We didn't want to move out to the West Coast, and the firm was really growing well. And it was a chance really to get involved in a startup, which is why I went to business school in the first place, but in this case, a startup as a venture firm. And I've been there for 10 years now, made 14 investments, had 5 acquisitions, and a couple of burials at sea, companies that didn't quite make it. So any questions on my background, or did I bore you to tears already?
So can you talk a little bit about the firm that you started and like how big the investments typically are?
Sure. So Flybridge is, we're on our 4th fund. It's a seed and Series A stage fund. So we have a total of $625 million under management, something like that, if I'm doing the math right, 635. And what we invest in, and this has changed over the years that I've been there, we really are focused on seed and Series A, so concept stage and maybe prototype stage as our first bite of the apple. And we'll continue to invest in the companies as they grow up. But we find that we've got a formula, kind of a strategy around those seed stage companies that's really been working for us over the past 8 or 9 years. And in this new fund, we really are focused on helping to cultivate those seed stage firms. And part of it, quite frankly, is that we have a great tolerance for risk. Our investors want that kind of risk because they want return. And because we're investing so early, we're getting kind of lower prices in terms of valuations of companies that's kind of consistent with taking the kind of risk we're taking, because the companies could go out of business very easily as they're just trying to prove that the concept is viable. And then as the companies grow, the companies that continue to perform will continue to invest and will bring more capital to bear as the companies grow toward either IPO or acquisition. And all we really focus on are software-driven businesses, and I put an asterisk next to it because a lot of businesses have got software behind them. So we span business to consumer, so B2C, as well as business to business or B2B. And it's we're really looking for inspiring founders who may not have a ton of experience in many cases, but have got passion and a vision. And what we think we can bring is based upon our experience, and most of us have been operating executives. What we can bring is really the help and guidance, the partnership, to help them, develop and evolve their strategy, to help them, recruit early customers to help validate the products and the services, to help them recruit the team, whether it's full-time employees or advisors. That's the kind of help that we bring in exchange for taking a percentage ownership in the company. There are 5 investors, and we'll be hiring a 6th. 2 of us in New York, 2 of us in Boston, and then we have a venture partner in Tel Aviv. And in addition, we have a group of about 20 advisors, and a Flybridge advisor is someone who's, in general, an active entrepreneur operator in the markets that we find interesting in terms of geography and in terms of sectors. They tend to have interest in angel investing on their own, so they'll bring new investment opportunities to us, introduce us to startups and founders. They'll co-invest alongside us. They'll either sit on boards or sit on boards of advisors with the companies. And that's one way that we kind of punch above our weight class with a small fund, is these advisors are kind of always on the lookout and are able to help us and really act as a force multiplier. So,
what year are you in your fund? And you said that you invest in a broad sort of B2C and B2B. Do you have a specific investment thesis behind the fund?
Yeah, so we just finished the first year of investing from this fund. So we've got about 2.5 more years of active investments, and then there'll be follow on. Each of us have got, the way I think about venture is that it's a combination of both being proactive in terms of trying to think about where the markets are headed and where good investment opportunities will be. And then reactive in terms of just making sure that you have kind of an open dialogue and that you're inviting to entrepreneurs who come in with ideas that aren't in those theses. So for us, we've got kind of probably 6 or 7 broad categories that we focus on. It's really themes as opposed to specific sectors. So one of them is kind of around the changing infrastructure. In a B2B sense, the changing infrastructure for enterprise and web scale businesses, where we've moved from a monolithic structure, which kind of dominated even in the early days of the web, into now kind of a componentized internet. And one sub-theme that I'm really been driving the past 3 or 4 years is the notion of kind of the changing control plane. And the control plane is really the set of services that allow ops professionals and IT professionals to monitor, manage, scale, and secure infrastructure, whether it's for a service provider, or whether it's for an enterprise, small business to large businesses. And with that in particular, my point of view is that the world is moving toward scalable cloud services that are kind of built on components that are actually other service providers, and that therefore the way that a company is going to manage their infrastructure is very different than it was 5 years ago, let alone 10 years ago. It's an outside-in approach where there's very little that's left in the kind of within the perimeters of the enterprise, and most of the services are provided kind of in the cloud. But the IT professionals and the ops professionals, even though they don't have the authority to place software and hardware kind of on those different cloud service providers the way they would have 10 years ago, they still have all the responsibility. So if something breaks down and the performance is slow, they're responsible for it. If there's a security hack, they're responsible for it. So it's really complicated their jobs. And as a result, I've really been focused on finding and investing in companies that are absolutely focused on that point of view. Others of my partners are focused on different parts of infrastructure, and as you move across the spectrum toward B2C, my colleague Victoria Song is really focused on what she calls kind of the emergence of the urban millennial, and it's the notion of millennials kind of returning to cities for obvious reasons of finding work and culture and a bunch of other things, and yet their take on the sets of services they want is very different than my generation or your parents' generation. And so that's led to a bunch of different sub-themes for her, including thinking about things like, well, on-demand services like physical storage, where, if you're living in an apartment in Manhattan, in Flatiron, and you've got a very small apartment you're sharing with 2 roommates, but you've got a lot more stuff that you can't actually fit in there. What do you do with that stuff, and how do you get access to it when you want it on demand? And that led to an investment in a company called Omni. As we think about the desire for fresh food and kind of changing the kind of logistics chain and the pardon the pun, the food chain of the way that fresh produce is provided, it led to an investment in a company called Nibby, and Nibby is really focused on kind of changing how farming is done and bringing it into the urban setting. So that kind of gives you a sense of it. And so a lot of these are proactive sectors where my partner Jeff would say that we're really responsible for being alligators. And in that case, we're trying to find interesting pools to lie in them, get smart about those pools, lie in them, and then wait for really cool things to float by so we can snap them up. And then on the reactive side, venture capitalists are wonderful at being reverse historians. So over time, if great entrepreneurs bring interesting ideas to us that weren't in those themes, remarkably, our themes will adjust as we start to invest in those new themes. Does that answer your question?
Yeah, it does.
Right. Anything else here before I talk about kind of a history of venture capital?
No, I think so.
Okay. And then in this section, because I can't see all of you, just yell out if you want me to stop or if you want me to just move along. Okay. So, some of this stuff was meant, this is a catch-all presentation, so a lot of this stuff is really meant for a less sophisticated audience. All of you understand what equity is, right? Yes. Okay. So let's talk about the types of private equity, right? There's venture capital, which is, even though it's given a broad name often in the popular press, it really is the focus on the financing of startups, where the eventual goal is IPO or acquisition. The rest of private equity includes LBOs, mezzanine financings, distressed debt, a few other things. But a venture capitalist, so what I do is very different than, say, what an investor at Apollo or Texas Pacific Group does, even though they're also in private equity. They're buying businesses that are up and running, that are generally profitable, that have financials, and you can do modeling of the financials. They're buying them based upon a combination of equity and debt, and therefore financial modeling really matters. I'm backing 2 founders and a dog in the basement of some dorm, where all they have is maybe a cruddy PowerPoint presentation or keynote presentation. And so it's much more concept stage. And so I can't understand, like, if for those of you who are MBA, MBA candidates, and you've learned about weighted average cost of capital and kind of doing discounted cash flows. I remember that stuff from business school, but I've never had to do one of them in almost 20 years of being a VC. It's much more esoteric, and it's much more based upon vision and strategy than it is on numbers at the stage where I make my first investment. Right. So, I've talked about this, right, a little bit. Now I'll share these slides later. So the unofficial start of venture capital, I love this when we did the research on it. We can credit Queen Isabella as being kind of the first venture capitalist. She backed Columbus's mission. He was the first entrepreneur. He tried to get it funded by competing venture capitalists in Portugal, England, Genoa, and finance. She financed it by selling her jewelry. And the deal was actually a pretty good deal. She got 90% of all. I guess she was the first LP. She got 90% of all future profits, while Columbus got 10%. In the end, he was fired and arrested, and he didn't invest. Startups come in all shapes and sizes, and so here's just, for those of you, these are mostly New York startups, as that's my my playground. And the way that we think about it are kind of seed investments, going to Series A, then kind of Series B and C, and then kind of the later stage rounds. And there's some shameless shilling here. Better Cloud, Mongo, NS1, and Valamail are all our companies. So, the different stages of funding, the way that we think about seed is that it's, a little money. So it's $50,000 up to $1 million. Maybe, I think it's creeping up to be probably $2 million. The Series A can be that, $2 million to $7 million. That's going up to about $10 million, and so on, going forward. When you look at the seed, the sources of the capital would include angels and seed funds and early stage VCs like us. And really what you're investing in is to find product and user fit. In the Series A, you're really focused on, angels may continue to invest and you'll get follow-ons from them, but it's really venture capital firms that focus on those early stages. And there you're really focused on investing to try and vet the business model. As you move to the Series B and C, really you get to scaling things up. The business model works. You're investing, to kind of scale up the sales and marketing. And then beyond that, you've got a company that's starting to hit inflection if it's a positive follow-on investment. And there you'll see kind of later stage investors. I'll take a pause. Any questions there?
I think so. Yep.
Okay, great. So, one question that we're often asked by, first-time entrepreneurs is why raise money from someone else at all, and why raise it from institutional investors? So, money is helpful for hiring great people, for helping to, basically fund the scaling of a company, to develop products faster than your competitors, to basically provide sustenance. And most companies are very expensive to build, even if it's not expensive in the early going. And that's one of the things that's changed in my time as a venture capitalist is, for a software company and even the B2C companies that I was describing that had to rely upon infrastructure, 10 years ago, they had to buy it all themselves. And it probably cost $5 to $10 million just to prop up the infrastructure before you could even tell if your business model worked. And right now, that's a lot cheaper. That's where the $500,000 to $1 million can really do it, because you can rent your infrastructure. Amazon Web Services or Microsoft and GitHub and a bunch of other services you cobble together to build kind of the first infrastructure you need. But over time, those companies, even though they might have been cheap to fund in the early going, in order to scale them, they'll still require more money. And very few companies are fortunate enough to be able to self-fund. If you can find a company like that, and the best example that I know of is actually here in New York, and that's Bloomberg. Bloomberg did, when they started Bloomberg, Mike Bloomberg and his co-founders raised some money from Merrill Lynch, but they had this wonderful negative working capital model where they paid it back pretty early in the company's history, and they've been self-funded ever since. And those are, if you can find a business and found one like that, please do it, because those are the best businesses. And business is very risky. So, taking someone on who's sharing that risk with you, is often helpful, but venture capital isn't for everyone. And, it really isn't the only way. So you can bootstrap through revenue, you can crowdfund. In some cases, I know some startups that'll end up taking a depressed public company and do a reverse merger into it, maybe on the Guatemalan Stock Exchange or something like that, or the Toronto Stock Exchange. And you keep going down the list. And the last point, you could steal your money, but that's not recommended by us or by HackNY or Shift. So why do startups end up raising VC? A, because they have no choice. They've got a dream, and the need for more money than alternative sources can provide, and the bigger dollar options just aren't available. So they can't go public because the company's too young, and they can't raise debt because they have few assets and can't provide collateral, or because they want to. Institutional investors can bring deeper pockets, but cash is a very fungible thing, and I'm selling entrepreneurs cash when I'm making an investment. So, my cash is expensive because we tend to push hard on valuation, not ridiculously so. But the reason that I believe my cash is worth more than the guy down the street is because of the value add. And not every venture capital says they're value added, but what we bring is really a combination of experience and this value added in the domain, with industry contacts, with strategic planning, and in particular because we've been on the entrepreneur side of the fence, we have great empathy, and we know who runs the company. It's not us. We've hung up that saddle. We don't want to run companies anymore, and the idea of being a coach and a mentor is really and doing kind of doing this with multiple companies at the same time is what we find fulfilling. And most VCs tend to avoid investing in niches. They're really trying to invest in transformative ideas to build really large companies. So a brief history of venture capital after Queen Isabella. American Research and Development in Boston is credited with being the first institutional venture firm. It was a French general from World War II named Georges Doriot, who was a professor at Harvard Business School. And they're credited with funding one of the first very successful computer companies, a company called Digital Equipment Corporation, which no longer exists. And they actually are also credited with spinning off a bunch of the early venture capital firms, including my old firm, Greylock. As you move forward, from 1946, the venture business was really kind of a clubby business, and it was very uniform. It looked, people were generally were blue blood, had gone to, you'll see, if you saw me right now, you could see my fingers, quote marks, kind of the right schools, and worked at the right companies. They were raising money from wealthy families largely, and they were investing in companies that had already bootstrapped themselves. So it was less of a risk, and they were really doing capital deployment. Over time, though, venture capital started getting earlier and earlier, and as I'm sure most of you know, nature abhors a vacuum, and arbitrage moments don't last forever. And so that cottage industry started ballooning. And so if you look at, the amount of capital, Greylock's first fund was like $10 million in 1965. And their latest fund is $1 billion. When you look at the total amount of venture capital that's gone into the business each year, these numbers are the amount, not that are going into funding companies, but the ones that are coming from our investors into venture capital funds. It started, kind of in the early 80s at about $1 billion to $1.5 billion. By the year 2000, this is really at the height of the tech bubble, when the industry went, when I got there, from having about 3,200 professionals investing to something like 10,000. It went up to $100 billion raised. And that's absolutely what caused the bubble, because there weren't enough good ideas to take that $100 billion. And what also happened was, if you remember, I told you that to build infrastructure for internet companies required a lot of capital. So a lot of that money was going into buying servers and software and consultants and Aeron chairs and custom-made carpets and a bunch of other BS that really wasn't helpful. And then somewhere in the year 2000, in the spring, someone realized the emperor had no clothes. And there was this domino effect where these consumer internet companies, which are all about eyeballs and that had no business models, started falling first. And then all the infrastructure companies, the stuff I was investing in back then, realized that without those companies to buy their stuff, their markets evaporated too. So we had this big correction where it went down by 80%, crashing in the early 2000s. The industry probably was cut in half, and now it's probably been cut almost back to where it was when I began. And it's started coming back, and you'll see that last year was really the biggest year since 2000. But it's important to note that venture capital, funding going to venture capital, is a very small portion of the U.S. gross domestic product. But in terms of the impact that it has on the economy at large, it's huge. It's been huge. And you guys know all the names of venture-backed companies, including Google and Amazon and Microsoft and Cisco and eBay and Uber, and you keep going on, that are all venture capital backed and have had a really transformative effect really for the past 30 years. So let me pause there, and then we'll talk a little about funds and fund structure. Any questions?
I have a couple questions. Can we go back to when you were talking about self-funding? Why do you think it's better to self-fund rather than go through a VC? Because being backed by a venture capital fund, isn't that sort of a mark of credibility nowadays?
So, let me just enhance what I said. I don't think venture capital is right for every company, and I think that with my entrepreneur hat on, which I really do consider myself first an entrepreneur and second a VC, the longer you can wait to raise institutional capital, I think the better the lessons are, and also the more of the company that the founders and therefore the employees get to retain. Not every company can afford to do it. Not every founder has got the dough in their bank account or the family resources to support it. And some businesses just require more capital from the outset. So I don't think it's an either or. I think that there's a spectrum.
Got it. And second question is, why did you leave Greylock?
It's a really good question. So, these are guys I learned the business from, and some very dear friends. But the center of gravity of the firm, I was in Boston, the center of gravity of the firm was shifting to California. And I didn't want to move to California. My family's all from the East Coast. My wife's family's from the East Coast. And, quite frankly, I didn't want to be the last guy out the door shutting down the lights in the Boston office. And so I left early. And, because I was the only young guy in the Boston office, my partner, Chip Hazard, was at Greylock with me for 8 years. He left 2 years before I did to start Flybridge, and then I came and joined him. So the chance to work with really close friends is just something that doesn't come up that often. And so that was really, I'd say the main thing was I had this opportunity to be in a startup, be an entrepreneur in venture capital. And, as much as I loved Greylock, and it was a wonderful place to work and still is, I just, I wanted to do something different. I wanted to, to do something on my own. And like most entrepreneurs, I wanted to have an impact and to, kind of put my own future, at risk.
Does anyone else have any questions before we go on to funding structure stuff? Cool.
Anything else?
I don't think so.
Okay, let's keep going. So, some terminology. Venture capitalists. I am a general partner in my fund, and my investors are called limited partners. And the sources of our capital include universities and charitable endowments, pension funds, wealthy families, funds of funds, etc. We raise a fund and invest the proceeds in companies. So the lifespan of a fund is 10 to 12 years, but the active investment period, kind of the first investment period, is like 3 to 5 years, and for smaller funds like ours, it'll be 3.5 years. And so then we continue to follow on investments through the life of the fund. And that means that we're raising new funds every 3 to 4 years. We get paid in 2 ways. We get a management fee, which is based upon the capital under management, and that, in our case, it declines over time as we've drawn down capital. And then we get carried interest, which is really our split of the gains. And so in general, you'll hear 2 and 20 or 2.5 and 20. And so we have a 2.5 and 20 fund where if I borrow $1 from you as my limited partner investor, I pay you back that $1, and then for every $1 we make after that, you take 80%, I take 20%. So particularly with smaller funds, what that means is I'm not getting rich off the fee, which is really the way it should be, and my interests are aligned with my investors and with the entrepreneurs that we back. And in fact, it's we get kind of, I don't want anybody to lament for me, we get kind of the worst of both worlds, and I'll talk about in a second, in that our investors get paid first, along with the founders and the employees of the company, and we've got to pay back, kind of the money that we've drawn down, the fees that we've taken, and the losses that we've incurred early on until we're kind of above water. And I've got a diagram that talks about this. In general, as a general partner, we have the full authority to manage the fund, subject to the charter of the fund, the deal that we strike with our investors. And it's super risky. 1 in 10 company exits are home runs, if you're lucky. And 1 to 3 investments make an entire fund. So a great fund will have 1 unbelievable investment, 2 really, really good ones, and you can have the rest just kind of return cash or lose cash.
What do you define as really, really, really good companies? Is there like a percentage that you're looking at? Or?
No, it's something like, the way that we think about it, and this is maybe different among most funds, but, in general, our investors have a choice of where to put their money. They're looking for risk because they're looking for return. So we've got to be better than, by several hundred basis points, kind of an index of, kind of the S&P index or something like that for our vintage. But another way of thinking about it is a great fund returns 3 to 5x of the fund of all the capital in. And so therefore, a winning investment might be 50 times, like a huge home run would be 50 times the investment, 100 times in the case of Sun. And a really good one is 10 times. Okay, keep going?
Yes.
So, how do we make money? Here's a little example. So here's Mike. He needs capital. He wants about $1 million to get to the next level. So he talks to Flybridge and we hit it off. And we want to invest. We think we could help him build a company, and it could be very valuable. Company is pretty early stage, has some customers and some traction, and we value the company at about $4 million before the investment. So $4 million for the investment, $1 million the $4 million is called the pre-money valuation, $1 million is the capital raise, so $5 million for post-money valuation. So we buy 20% of the company. And then the rest of the 80% is split among the founding team members and perhaps other investors. So we invested the $1 million. At an exit of $1 million, we get our $1 million. We get our $1 million back because we buy what's called preferred stock. And so the preference, and we have a very simple structure. Some firms are more complex. For us, it's called a straight convertible preferred. It means that at my option, I can convert into common, and I'll only convert into common when I would make more money otherwise. So in the case of this $1 million exit, I invested $1 million, and if you as the managers don't make any money on it, I get all my money back.
Got it.
You've added no value.
So if they were to sell for, let's say, $1 million, then you would get that back and there would be nothing left.
There'd be nothing for the founders. It basically meant that they added no value whatsoever to the capital raise. In fact, you could argue that they destroyed value because I value the company at $5 million, and they're only selling for $1 million.
Got it.
Okay, now I don't make any money with that. They don't make any money. It sucks for everyone. But now you can see at some value, and you can think about the graph of this, I will convert into common stock, and then I get 20% of the proceeds, and that's where those other numbers come from. And this is dated. Our current fund, that's our last fund, was 280 million. And what this means is this. You've got to have these home runs in order to return these funds because of the hit ratio being so low. And it's a very simple example, and there are many more nuances. So I talked about the J curve, and so this is, the way to think about venture business, which is, look at the timeline going across horizontally. We fundraise, we look for investments, we invest capital, we monitor and manage the portfolio, and then literally the average tenure is about at year 8 we start getting some positive liquidity. What this means, though, is that that blue curve means that we're in the red until we start returning capital to our investors. And and again, don't lament for me, but I won't make money on that carried interest on the proceeds until I've returned my capital plus fees back to my investors.
Oh, we actually can't see the slides.
You can't see the slides at all?
No.
Oh, you guys should have said something like 10 minutes ago.
I thought you were just referencing them.
Oh boy, I've been, hold on. You've been looking at me. I'm glad I wasn't picking my nose. Here, now can you see it?
Yep, there you go.
How about now?
Yeah,
Yep,
good.
all good.
Oh man, you guys, come on, you gotta speak up. All right, now you see all these great slides I had. All right, so here's the J curve. And basically what it means is you see where it intersects at around, starts to intersect around year 5, and then it gets above, kind of water, where you see it kind of at the liquidation in year 8. My former boss at Greylock, my mentor there, referred to venture capital as a get-rich-slow business. If you're lucky and you return the fund, it is a great way to build a career and to build wealth. But most venture capital firms don't make money, and most venture capitalists, therefore, never are in the carry, so they don't get the spoils. I talked about the life cycle a second ago, so I'll skip that. We talked a little about the life cycle. So someone asked before about sectors. There are different specializations, by sector, by region, by stage, etc. All right, let me pause there and see if there are any other questions.
I don't know if it's intentional, but the slide is still on the J curve.
It's not. It should. I think it's Google not.
Yeah.
Is it moving now?
Yeah. Switch back and forth real fast, maybe.
Yeah. How about there? Do you see it? Specialization.
It's on the J curve.
Oh, great. So Google. This is. What do you see now? J curve still?
Yep.
Yeah. It's
You may have to
frozen on
take
that
it off for a second, switch, and then readjust.
Yeah. It's amazing that this technology doesn't work yet. See my screen now?
Yes.
Okay. So let me just see. How about say VC fund cycle, life cycle now?
Yep.
Life cycle of investments.
Yep. We're in sync now, I think.
Okay. And specialization. All right. So let me pause there. Anything else for me?
If so many VC funds fail, A, how come we don't hear about them more, and are there enough case studies out there about why and how they failed?
Why? It's well, first of all, you don't advertise that it's failed, and also it's a long, slow death because remember, earlier I told you in the slide you didn't see that the life cycle of a venture capital fund could be 10 to 12 years. So in many cases, hope springs eternal, and you never know. If the average gestation of a company's liquidity is 8 years, it could take a while.
Yeah.
And if you have one unicorn, and I can think of some firms, I won't name names, but some firms that were thought to be kind of on death's door, and then they have a massive exit, all of a sudden they look brilliant.
Gotcha. How many funds would you say, you know, a venture capital firm could raise then before you know for sure whether or not it's actually a good fund or like a sustainable fund per se? Because you say that you fundraise what every 3 to 4 years for your next.
That's a great point. It could take 4 funds. I mean, you know, it could take 3 or 4 funds.
Gotcha.
You're selling on the rumor, not the results, as you're raising those earlier funds.
Gotcha.
All right, I'm going to stay on this this way of doing it. It looks like it seems like it may be better. You guys can see it, right?
Yeah.
Okay. Any other questions before I talk about business plans and kind of what we want to see?
No.
And is that helpful? Do you guys want to talk about kind of what venture capitalists look for in a business plan?
Yes,
Yeah,
please. Yes,
absolutely.
definitely.
Okay. So generic elements of a business plan are really these, and you know, it's the team, the market, you know, the opportunity, go-to-market strategy, the solution, operating plan, and risks. And you can also think it's not required. You can also discussing the problem. So not just the opportunity, but the problem, I think, is part of it. When we think about the team, what skills are covered, which skills are missing. Is the market you're going after an existing market that you can dimension? With a new market, how do you demonstrate demand and maybe create the vision that it could be really big? When you look at the opportunity, this is also where the problems come in, which is what are the key issues that aren't addressed by incumbents if it is an existing market, or if it's a new market, what's the big idea, and kind of what gives you confidence as a founder that it's going to be big and the market's going to evolve. When you look at the solution, if you're going after an existing market, why is it unique and differentiated? What's your vision for world domination? And then in the go-to-market strategy, it's really, what are you going to build first? How are you going to acquire customers? What's your methodology for distribution? How are you going to price it? If you're going to price it to start with, or is it a land grab for users? And operating plan, and this is for, again, earliest stages of things. We want to see, kind of early financials and, maybe a little bit of inside baseball. I really think anything with your revenue projections are bullshit in the early stages. It's really what I'm looking at is, do you have a sensible expense plan that we can think about how much capital to raise for the company? And there are other elements of it as well. This is really just highly stylized. Competition would be part of it. A bit more of kind of your resource plan. What does it take to do it? If it's a seed investment, what are the milestones that you're funding toward? Those types of things. So this is a build. Let's see if I can do this. Can you see this slide? It says valuation.
Yes.
Okay. And this came from the famous London School of Economics. I've got a problem with the logo there. This is how they said, step one, estimate VC's exit date, forecast cash flows, estimate the exit price, choose a discount rate, discounted cash flow, blah, 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 and that's all rubbish. Really, in the early stages, evaluation is the function of the money needed to reach milestones, market comparables, the needs of equity for both the founders and the investors, and then who negotiates well, and then is there competition for the deal? And most of these things are really subjective and not objective, except for the amount of money to reach milestones.
I have a quick question right there. With I guess less sophisticated startups, for lack of a better term, if they don't understand their financials fully, but you see an opportunity there, are you more patient with them and you're willing to explain this to them and really assess the opportunity there? Or are you less likely to invest in those?
No, we have to be. I think not all venture capitalists are, and you got to kiss a lot of frogs in my business. But a lot of this for me is just kind of paying it back. I had very patient investors when I was on the other side of the table, and these diamonds in the rough, like especially with a small fund, I have to be willing to invest the time in helping to help support and maybe mentor younger founders and first-time founders who are less sophisticated. And so, and it, you know, it's with smart people, it doesn't take very long for them to catch on. So it's not like it's wasted time.
Very cool.
With sort of questionable financial projections, or even like a business model that's oftentimes fluid for early stage startups, how important is like target addressable, serviceable, addressable, tangible markets to you then?
Yeah, I mean, so this is all business school stuff, TAMs and SAMs and all this stuff. You know, there's an old saying among management consultants that a great management consultant can torture data to make it tell it anything that they want to hear.
Yes.
And the same thing goes as you're doing these projections. I've never seen an entrepreneur come to me that doesn't, you know, who doesn't eventually say, I've got a multi-billion-dollar market. And so the reality is, you know, again, there's two broad categories, right? Going after an existing market, you can dimension it. And then, like, if you're building, you know, if you're going to take down Uber, which is still early in its life cycle, there are numbers out there that are pretty, you know, kind of, there's great veracity to them in terms of the size of the, you know, of that market, or, you know, in the, you know, Airbnb market or something like that. But if you're creating an entirely new market, what we're looking for is the logic that you bring in terms of why this would be big. And that could be, it's another market that is measurable, could be a proxy for it. It could be, you know, based upon surveys where you've gone out and talked to a statistically significant sample size and tested a product and tested pricing, and then you extrapolate from there. Or it could just be this vision, like, you know, Mark Zuckerberg, you know, we didn't hear the pitch for Facebook, but, you know, he didn't have numbers that talked about how big the market could be in great specifics. He was painting a vision of a platform that would be used by everybody on the planet. And if you believe in that, if you believe that, you know, an entrepreneur can get there, with something like that, you got to assume that the money's going to follow. If you have that much of an audience that is persistent and engaged, you know, and I want to hear you talk about how you're going to get, what's the proxy for that? How do you know they're going to be engaged? How are you going to acquire them very cheaply, particularly for a business where you're not going to charge anything for the first several years, or, you know, and if it's an advertising driven business, until you have, you know, 10, 20 million monthly uniques, you can't sell that audience to a brand or an advertiser. So therefore, the cost of customer acquisition becomes really critical when the lifetime value is zero.
Got it.
Okay.
Yep.
So what VCs should provide are funding, but also guidance. You know, so, you know, we usually sit on a board of directors. We help provide advice and set goals and review them periodically. And the value really depends on the individual, the experience, the relationship. You know, ultimately, as an investor, I'm buying a minority stake in your company, and by virtue of the documents that we sign together, I can really only legally do two things if it's a kind of a you know, normal kind of vanilla entrepreneur-friendly investment. And those two things are, I can decide to put money in going forward or not to put money. That's one thing, because I get pro rata rights on investing. And in general, my deal says that, you know, as being part of the board of directors, we could fire the CEO or hire a new one. And everything else, in terms of, you know, in terms of guidance, is really based upon the relationship that I build with you. If I don't have a good relationship with you, then you're not going to take my advice. So this relationship, you know, another guy that I learned from at my old firm used to say, and this is kind of a perverse way of saying it, but I think the description is apt, is taking venture capital money for an entrepreneur is worse than getting married. Because your venture capitalists can divorce you, but you can't divorce them.
So what happens when there's like a misalignment of values?
It really sucks. I mean, honestly, and so I've seen it in both ways. I mean, there are sometimes, you know, when founders go haywire because they were always a little bit crazy, and it didn't show up early, or something happens in their life,
Yeah.
and they kind of go off the reservation. And likewise, there are times when the venture capitalists do the same. And the remedy can be pretty ugly. In the case of the former, firing a founder is not an easy thing to do. It's nothing that we want to do. In fact, the best companies have had the founders there from beginning to end. And particularly in the very early going, it often means the death of the company. Firing a VC is very hard, particularly if you have a senior guy on your board. It's not like you can go to it's not easy to go to his other partners and in a he said, or she said, he said, or something of that ilk, to get them to boot that guy off. And that's what I meant, like, it's tough to divorce your investor. You can't divorce your investor.
Gotcha.
So what it requires on both sides is really meaningful due diligence. And so for founders, that means you go find people who worked with that VC, that investor in the past. In particular, you'd like to find people they're not giving you as references. A good venture capitalist will say that every investment he's made is a reference, whether it was success or not. And a more tricky one will only direct you toward there are good investments where there are positive outcomes. And it's up to you to use your wits and resources to find out what it's really like when that person sits on your board, because I'm going to be on my best behavior when I'm courting you, just like you're going to be. And you got to find out what it's like afterward. And there are ways you can test it during diligence as a founder. You can essentially give action items to the venture capitalists as they're trying to curry your favor. You can say, hey, I'm asking all the venture capitalists to introduce me to 3 potential customers, or something like that. For us, it's very similar. You're going to give me some personal references if I've never worked with you in the past. I'm going to check all of them, because occasionally, it hasn't happened very often in my career, an entrepreneur will give someone who will give them a bad reference, and it's the idiot test. If you give me, I'll check every reference. If you are dumb enough to give me a reference who you know is bad because you think I'm not going to check him, I'm going to check all of them. And then the more important ones are, because you can get false positives from those that are provided, is I'm going to tell you, I'm going to go talk to people who you've worked with in the past. So I'll say it very politely, but I'll say something effective. Is there anything that you want to tell me that I'm likely to find out when I talk to people who have known you for a while?
And how forgiving are you with that typically?
Well, what I typically do, unless I find something that was completely a misrepresentation, I'll just have a conversation with the founder and sit down with her or him and just say, listen, here's what I heard. Help me interpret it. I want to hear your side of the story. And I protect I protect those who I speak with, right? Sometimes you get very difficult conversations and you find out stuff about people that you can't reveal. And that's the hardest part of my job, when I have to turn down something because I found something about a founder which was lethal.
Sure.
And in that case, I have to protect. Like, it's clear there may be only 1 or 2 people who could have given me that reference. I've got to protect them, in which case I'll be less transparent. I hate it because that's not something that someone can use to be helpful going forward. And so I try. I mean, I've only had to do it a handful of times in my career. But if someone in confidence is giving you feedback, you have to protect that confidence.
So you mentioned a little earlier that you look for inspirational founders, but at the same time, you're looking for very early companies in that regard. So you mentioned now that you also have the power to hire on or fire a CEO in that regard. So if a founder comes to you with a strong vision, but oftentimes maybe lacks experience or the skill set 24 or 36 months in to take the company to the next level, if he or she comes to you and tells you, 6 months ahead of the time that they feel like they're hitting their ceiling, do you take that as a sign of maturity, or as a sign that sort of this company doesn't fit into the category of the best company where the founder stays on from?
I think the best companies, I'll actually make it in a different way, which is if I built the right relationship with you from the beginning and sitting on your board and working with you, it's not going to be a surprise to anyone. And then it's going to be a conversation. And the best founders basically say, listen, I'm starting to feel the stress of it. I'm missing things here, and oftentimes I'm playing coach, or we brought someone on board as an independent board rep or a true mentor coach, and so the dialogue is going on. And very often at the beginning of an investment, at inception, I'll have a conversation with a founder, basically saying, listen, everybody, including your VCs, rise to the level of incompetence. It's very rare that you find a founder who is founder CEO that, when the company is, 20 years old is still in the seat. And you can think of on a hand, you can name the guys. It's Jeff Bezos, right? It's Bill Gates. It's Larry Ellison. You can go through, other companies that have been long-lasting companies. But more often, there's been a transition, and the best companies figure a way to do that kind of peaceful transition of power. And so a CEO who comes in, a founder CEO comes in early on and says, listen, I think I'm starting to hit it. I see that as a sign of maturity. And then we can work on it together. Because like I said, the best companies have got those founders, and founders there from beginning to end. All right, should we keep going?
Yep.
Yeah.
You're still stuck on the valuation side if that's.
Oh, damn. All right, so.
It's moving, the pitch.
Yeah, the pitch.
Okay, hold on. I really want to see if I can play this video for you guys.
I'm pretty sure there's an application.
Silicon Valley's up first.
Okay.
Yeah, I'll have you do it. She wants excellent. Be best. I heard about it.
So, can you guys see the pitch?
You can buy it in the next
Yeah.
3 days.
Is it gonna play?
I hope so. Give it a second. If not, that would really stink.
Well, if you can send us the slides that we can watch.
Oh, wait, hold on. Is it coming? It's not coming. It says it's playing. All right, so this is you guys know who Sacha Baron Cohen is, right?
Yeah.
So, Borat and Bruno, and he did Ali G on HBO. There's a show, 10 years ago. And he did this brilliant thing where he pitched to venture capitalists in New York his idea for an ice cream glove. And basically it was a Rubbermaid glove to eat ice cream with. It is great. I would search it on YouTube. I'm sure it's there. It's absolutely amazing. And it just shows you, and by the way, the VCs he pitched to all fell for it with the exception of Donald Trump. He went to, and Donald told him to get the hell out of his office. All right, do you see the next slide?
Yep.
All right, so how do you win venture capital? What's a winning pitch look like? And unfortunately, there's a little element of kind of a contest here, a beauty contest, and really, a great pitch is the part of the key, but it's not because of the flourish and and glamour, but it's really because it demonstrates great strategic thinking on your part as an entrepreneur. And every pitch is different, but there are common themes of effective pitches. They establish excitement about the team, whether the team has the experience or not. It sells the vision. It outlines the market opportunity, shows metrics, for businesses that exist, or how you're going to measure things for those that are nascent, and really addresses the challenges. And the next slide. Can you see the next slide now?
Yep.
So we back people. And, vis-a-vis the conversation we just had, we want to help them win and stay with the company until we all ride off into the sunset and having made a lot of money. But the teams don't need to be complete. And in the early stage investing that I do, they rarely are. But founders and managers must have confidence to successfully perform a wallet extraction. But more, what we look for in the founders are command of the business, the sector, the ecosystem. They've got, regardless of whether you've been in this market before, regardless of whether the market existed before, you've got to demonstrate that you got it, that you're not, that you've done your homework. that you can articulate concisely the value proposition. You always hear about this elevator pitch. It actually matters. If you can't, I still maintain that if within 3 sentences and 4 floors of an elevator ride, if you can't articulate what you're doing, who you're selling it to, and why it's important, you haven't done enough of your homework on it yet. Or the likelihood is that your business isn't any of those things. And so we want to see evidence that you've done that homework. And confidence without arrogance, which is kind of a difficult balance. And the next line is really important, next point, of being a Pied Piper. This is something that you see in great founders, regardless of whether they have the experience. Mark Zuckerberg is a great example. He was able to recruit a great team, to retain that great team. Larry and Sergey did the same thing at Google. And not just of team members to come on full-time, but of advisors and partners. And then on the team, we're looking for interpersonal chemistry. I can't tell you how many times we see pitches where it's clear that there's some founder issues, where founders talk over one another. Or 5 people show up for the pitch and only 1 person speaks. That's a dumb move. Why bring them, right? If you're not going to say anything, here's a pro tip. If your team members aren't going to say anything, any team members aren't going to say anything when you have a pitch scheduled for investors, do not bring them. So are we on the next slide now?
Yep.
So the most important thing that you can do when you're pitching to an investor is to sell the vision that you're building. Share your excitement and your conviction. Get us excited about what you're doing by telling a story. And the best presentations that we get are ones that tell a coherent story that kind of engage the audience. And venture pitches are no different than that. You're selling yourself. You're selling why you are the right team to tackle this business problem. And you're leaving us wanting more, wanting to learn more. Almost no investor is going to write a check after 1 meeting, at least no VC. And in particular, when the balance shifts, the pendulum swings between investors maybe having a little bit more power in the negotiation versus entrepreneurs, it's less likely to happen that after 1 pitch, you're going to get funded. And that also depends on how much money you're trying to raise. But the goal of your pitch is really to get the investor wanting to spend more time with you. You want to learn more about that investor. Now, it's also very different if you've had a relationship with the investor in the past. I've backed guys on 1 pitch who I've backed in the past. I've known them. I've been in business. I've made money with them. So it's really more apropos of new relationships. Next slide. Can you see it? So we want you to outline the market opportunity. After the team, the market is most critical. What I talk about the difference between I call it base camps on Mount Everest. Like a lot of entrepreneurs and at various times will talk about the idea of foothills, investing in hills and successively bigger hills until either in aggregate they make a mountain or there's a mountain behind them. And oftentimes that's just not the case. It turns out that there's only a smaller hill behind the first hill. And it's very hard to create a big business based upon an aggregate of smaller ones. So what I'm looking for is someone who's got a vision for something that could be huge. I don't need a lot of details about that vision, but here's my vision on what it's going to be. And where I'm starting from is a base camp where I know that I can get to the top of the mountain, but I'm not sure which path I'm going to take. And this the last big bullet here is the one that someone had asked before. Presentation could clearly articulate the size of the market being addressed, but how you do that for markets that don't exist becomes this exercise of your vision. I'd like you to show metrics. No matter the focus of your business, demonstrating traction goes a long way. So, 2 identical pitches where for a non-existent company at this point, a company could come in and company 1 could come in and say, my idea is to make this ice cream glove, and I've gone out and I've interviewed 2,000 consumers, and here's the data, and what I found is these are the kinds of customers that want ice cream gloves. These are the ones that don't. This is how I reach them, etc. It's born of that homework. And company 2 could come in and just say, I really think there's a vision to sell ice cream gloves. I'm going to choose company 1. This is an example from one of my companies from a few years ago. where they basically and I funded the Series A, and during their seed they just went from 0 to in this case nearly 30 million end users using their end product. We want you to outline the financing goals. Tell me how much money you need to raise and why, and there's got to be logic around it.
So how often does someone ask for, let's say, like $2 million and then they actually get those $2 million? Or are people typically asking for more money or less money than they actually want?
No, it's not. The game isn't there. Sometimes we'll pad it. So if you look for 2, you raise 3. But particularly in the early stages, you're really funding to milestones, and it's important for both sides of the table. As an entrepreneur, the more money you raise with less meat on the bone that you've created, the more percentage of the company you're selling, right? And because it's not like just because you say I need to raise $10 million and if the deal was I'm going to buy 50% for $2 million, you say no, I want to raise $10 million. I'm not going to make the valuation 5 times more.
Yeah.
Right. And from the venture capitalist standpoint, this is all about risk mitigation. I'd rather fund it to stages. So if it turns out, particularly because these things are so risky, I don't want to, I want you to fail fast if you're going to fail, and fail on shorter dollars.
Got it.
Okay. And then talk about the challenges. I mean, the worst thing you can do is to ignore them and pretend that there are no risks, there are no challenges. If you go back to one of the first tenets, I want to know that you've been thoughtful about this business. And you can't be thoughtful without thinking about competition. You can't be thoughtful about thinking about the different risks, whether it's hiring a person with the right kind of expertise, or developing something that's new science or something like that. We're institutional smartasses as venture capitalists, and so we become instant experts on your business. And if I'm really doing my job right, I don't really know your business as well as you do. I'm just asking you tough questions. And you should be thinking of many of them you should have thought of beforehand. But here's another pro tip during a pitch, and I think this is on another slide. If you don't know the answer, don't wing it. And so do you see the investor's decision tree here?
Yep.
So what we decide is, we look at a pitch. Is it worth, a quick phone call or an email? If not, we ignore it. Is it worth, a small amount of time? And it keeps going down. And, this may seem a little cold-hearted and SAT or ACT-like, but I told you before that we have, 5 investors at Flybridge. I saw 1,000+ business plans personally last year.
Jesus.
I have to figure out a way of processing them quickly. And it's the same for everyone in the venture capital business. We miss a bunch of things, but also, quite frankly, at least the way that I think about it is, I'm going to give you feedback. If you've busted your butt to get in front of me and to put things together, I'm going to try and give you helpful feedback. But I'm going to give that feedback in some way, proportional to the amount of effort you've put in. If you send me an email where it's clear you cut and paste, and it was "Dear Investor," or in the simple way, people don't paste and match style. It's amazing to me. So you can see that one's in blue and one's in black. I know that you cut and paste. If it's a no, it's just going to be thanks, I'm not interested. But if I've had a meeting with you, a couple of face-to-face meetings, and I've passed, I'm going to sit down with you if you want to and kind of give you the direct feedback.
Do you find that those companies ever come back? And if they have they ever been successful at getting funding from you?
Sometimes it does. If they come back to me or they come back to wave it in my face, yeah.
Got it.
Sometimes. So this is more on the pitch deck. I want to go through this quickly because I want to be conscious of time. But we talked about to start with the team, hit the problem, talk about the market, talk about your solution, what is your product, and then show financials. And these are the do's. Do your homework. Figure out the people you're talking to. You can find out, most good venture capital firms have got enough social media footprint or web footprint that you can know what they've invested in. And if you're investing in, I can't tell you how many times I get, I had it today, some entrepreneur basically sent me something saying, David, we've looked extensively at your website, and we've determined that you'd be the best investor for our company, and we're making a next generation pharmaceutical. Never invested in pharmaceuticals. So, do your homework. Be comfortable saying, I don't know. If you make up stuff, we'll figure it out. And be open to feedback, so it should be an interactive lesson, a session, and this is where you're actually learning how the venture capital firms act. If they want to be, it's part of your diligence. Do you want to be their partner? If they're lecturing you, you can, and they're on best behavior before they've even made an investment, you can figure out how they're going to be acting after they make the investment. And I would also encourage you not to be obstinate and a know-it-all, but also don't be a sailboat. And just because someone who you think is smart and has money says something, don't just automatically say, yeah, that's a great idea, I'll do it. The don'ts. Don't include an exit slide. I don't believe anything you're going to put on it anyway. Manage your time correctly. You probably have an hour at most with an investor. If you take too much time talking about backgrounds or something that happened on the weekend, or even if the venture capital firms are doing it, you're going to run out of time and you're not going to get the point across. So be on time, and also watch out, because there's some venture capitalists who are incredibly rude. And again, this is how they're selling you before the investment. Watch it. They'll be on their phones, on their computers as you're pitching. Take note of it.
Do you comment?
Do not allow your participants to check email. So don't be rude even if they're being rude. Don't read every word of your presentation. There are some entrepreneurs and some venture capitalists who feel, I wrote every one of those damn words. I wrote them all. I'm gonna read them all. And don't make it so abstract. Don't make it so detailed that it becomes boring, but also don't make it so abstract that when someone leaves the room or someone wasn't in the room, they can't get the gist of what you're doing. And we hate people who exaggerate or name drop, that kind of stuff. That arrogance doesn't, that doesn't, fly well. Pause. Questions? I hear some rumbling.
I'm just wondering, I asked a question sort of getting at this earlier, but let's say they don't know how to make a good slide deck and they do read off the slide and they're kind of nervous, but in your opinion, they might have a good business plan. How lenient are you with that? Or is this kind of just like, I don't want to work with you because you're not able to present information well?
No, but so first of all, on a young team like that, I'll help coach them before they come into pitch to my team.
Okay.
And help them with slides, give them feedback on the slides, and I'll give them some coaching and don't read that stuff off it. But oftentimes with a young firm like that, we have to make the decision, not so much who we're backing today, but what's their headroom like for 18 months? Do we think they have the capacity to be a really fast learner? Mark Zuckerberg looked a lot different 18 months after taking his first investment than he did when he took it. But sometimes, the pitch to the entire partnership in a venture capital partnership is the kiss of death. It is, and it's unfortunate, and sometimes it's not recoverable. Okay, can I keep going?
Yes. Yep.
So you've had a good meeting. What next? Fundraising is like a sales process. You build a pipeline, manage that pipeline, stay up to date. I mentioned how busy we all are. We get distracted, and we can only pursue a small number of high priority new investment opportunities at any given time. So you want to strike the balance between not playing like you're too easy and not too hard to get. You also want a venture capitalist to show attention. And infrequently will you find a VC who's not proactively coming back to you is actually going to end up investing in your company. If you have to chase someone, they aren't likely to invest. Then you expect more diligence as you get deeper, particularly for, it's different based upon how much money you're raising in the stage of the company. And the more you can do to prepackage that information to help them along, the easier it is. Okay, so that's pretty much it. I don't have that term sheet here. I can talk about changes in the VC landscape a little bit if that's helpful. But this is really the last slide that I have. So why don't you guys tell me where you want to take it? And I've got probably 10 or 15 minutes before I have to head out.
Do you guys have any questions for 10 minutes, or what do you want to do?
Yeah, you want to do questions are fine.
Do you have questions?
I got a question. So you say that you invest mainly in seed funding and Series A funding, but then you also talked about firing or replacing the founders of a startup. So typically, what percentage equity do you take in a company? Or is it anywhere like from 10 to 90, or like?
Yeah, it's never 90. No, and also, understand that you never, at least we don't, maybe some investors who go in thinking that, you're going to try and fire the founders. So it's not, that's not in our playbook, right? We're backing founders. So typically what we do in a seed investment, the money, so if you raise $1 million or so, the money is going to buy 20 to 33% of the company. That's what we've seen. And we've seen seed rounds go from say $500,000 maybe to $2 million. And so you can impute what the pre-money valuation of the company is for that. I'm not writing the whole check myself. I syndicate everything. So in a seed investment, I'm buying between 8 and 13% of the company. After a Series A, I hope to have, I've done the seed as well, I hope to have maybe 20% of the company, between 16 and 22% of the company. And because I have a small fund, as the company progresses, it's hard for me to continue to do my pro rata. So I need to have that 20 to 22% of the company, because over time, even though I'll continue to invest, I'll get diluted just like the founders get diluted. And so we don't own majorities. Venture capitalists in general don't own majority. That's a bad sign if the founders have sold that much. It either means they're really cruddy negotiators, or the venture capitalists are jerks, or both. Or the company has really executed poorly, and the venture capitalists have decided to keep piling money in because they either believe in it or they've lost their mind. But that percentage ownership, it has nothing to do with the hiring and firing of employees. That really comes in as that's why we take board seats. That's why we think about governance.
For sort of entrepreneurs or like student-based entrepreneurs, if you will, that are sort of early on, that may not have the experience or the skill set necessary, what's the best way to grow that team, both from a non-technical and technical standpoint?
That's a good question. This is where I think that finding an advisor, an investor, someone who you build a relationship with and can act as a mentor. I mean, I think that someone who's been there and done that and can afford you the time to help coach you kind of on the ground, I think that becomes really, really important. And this is different than the part-time advisor. Oftentimes what we'll suggest is someone as a kind of the active chairman of the board. In U.S. companies, a chairman of the board doesn't mean the same thing as it does in European companies. And so it's a bit of a titular thing, but there is some implied importance within the structure of the company. But we have a few of our advisors who will end up being kind of like the old experienced guy in residence with a company, and they'll come in and they'll spend 2 days a week as the company's first getting started with founders. They don't want to be the CEO of the company. They'll act as kind of the mentor and consigliere to the founders, and they'll help do things like, organize, the structure of the company with you, help you think about from the mundane to the strategic. So how do you get healthcare plans? How do you do that kind of stuff? How do you think about a recruiting plan? And then also to more strategic things. And I think and they'll take equity for it. They may invest in your company as an angel, but then you'll also give them some equity in the company because they're going to be dedicating time to help you. And I think that's important as entrepreneurs. You want that to make sure that they feel an obligation to keep coming back. And that's probably the best single piece of advice, is to find someone who is so relevant to your business, who's got that experience that you can recruit to be your, kind of old smart person in residence.
Anyone else? No?
Nothing else. Come on, Michigan. When I did this with Wisconsin, they had like all sorts of more questions than you guys do.
Okay. Oh, shit, composition.
No.
All right, here's a scenario then. 3 founders. One founder's accepted a full-time offer, so these are all students. They are just incorporating. They haven't signed, and assuming that they'll all sign, standard vesting schedule, IP agreements, but the founder that has accepted the full-time offer still wants to go work full-time and wants to work on the venture part-time. How often does that pan out? Is it appropriate to keep them on the cap table because there's still that 1-year cliff?
So I've seen this exact scenario, but I've seen other ones, and kind of the close cousin to this is in those 3 founders, they split the equity equally among the 3. And that, by the way, is something where it's generally a disaster. So equity, particularly when you bring investment in, is often thought of as a commendation for everything that happened before and your commitment to the company in that phase. It's actually forward-looking. It's the exact opposite. And it's rare that 3 founders in the company are going to contribute the same amount to the company going forward. And so let me give you the best and worst example I can give you, which is a corollary to this. So I think the direct answer to your question is, I haven't seen that one exactly, but it's not a good sign to me. And it's very selfish on behalf of that first person, or maybe just naive to think that they're going to be able to contribute something. And on the side of selfishness, perhaps a little bit greedy in terms of trying to take equity when they're not going to be part of it.
Gotcha.
They're going to have a full-time job. So somewhere between naive and greedy. The best, worst example I can give is I backed a company with 4 founders years and years ago. 2 founders were technical, 2 PhDs coming out of MIT, 2 founders were business-oriented, they're out of HBS. And one of the connector was one of the business guys had gone to MIT undergrad and knew the other 2 from that. None of them were the CEO. One of them was the CTO. One of them was the kind of chief architect. The 2 business guys, one was going to be the head of marketing to start with, the other is head of biz dev. They insisted on splitting the equity equally. Myself and the other co-investor tried very hard to get them off that with an argument that it's forward-looking, not in the rearview mirror, and they resisted. And in the end, we said, vaya con Dios. That's the way you want it, we want to invest. They also insisted upon treating founders, with a concern over being fired by investors, an undue concern. And so they basically said that if you leave, you get everything. You can tell this is going in the wrong direction. So we again said, we don't want to do that. And they said, this is the only way we can get the deal done. It was a hot deal. We did it. So within the first year, the chief architect decided he wanted to go finish his PhD and left. He continued to be of counsel of the company he vested. The marketing guy decided it wasn't for him. The times got a little tough. He left. And then the biz dev guy, just kind of left unceremonious. He just left. He just. And so now the poor CTO is there, pulling all his weight, and his 3 good buddies are getting a free ride. Now there was some vesting with it. I forget what it was when he left. It wasn't full vesting. There was something, so I don't want to totally embellish this, over-embellish it. But it was a huge portion of the company. And the CTO, the company was eventually successful, but all those guys ended up getting a free ride. And it wasn't fair to the CTO. And we couldn't manufacture enough new equity to give it to him. And it's not like we said, I told you so or something like that, but there's only 100% of the equity. And when you have co-founders and everyone has a meaningful stake, it's very hard to rebalance it if you haven't been thoughtful about it at the beginning. And this is the hardest conversation really for first-time entrepreneurs to have, first-time founders to have, is how you split it up, because it can lead to a lot of, heated arguments.
I think the conflict, so the scenario I gave you was mine, essentially. The conflict I have is how to keep one of my technical founders properly incentivized with the 6-month outlook before he actually goes to his position. And I think it's, I guess, the assumption I made that it's not that harmful because there's a 1-year cliff there. If it comes down to it, and because he'll be working full-time in July, right? And if we incorporate now with a 1-year cliff, that'll give us 6 months roughly to evaluate his performance with regards to the contributing towards the company.
I think that just to push you on it, he's not working for 6 months full-time. He's working with you until he takes his job.
Yes.
You don't know how he's going to act after he takes his job.
Yeah, but then the point is that you have the 6-month buffer after he takes the job, right? And I want to ensure that the 6 months prior to him taking the job are.
Like I said, I'd be thinking about it differently, which is to say you treat him like an advisor afterward. And and by the way, we don't do 1-year cliffs with founders.
You know?
We do no cliff and vesting monthly.
Uh-huh.
And then the idea, a simple way of doing it that I've seen is you basically say it's pro rata the amount of time you put in. And it can be canceled, but we can take that offline if you want to. It's just, it's hard to work full time, particularly your first job out of grad school or something, and contribute in a meaningful way. It's just hard. Sorry, I'm being so harsh.
No, I appreciate it.
Yeah. All right, guys. One last question. Anybody? I've sufficiently bored you.
I'm curious. What is actually? Does anyone else have something else like 80 questions? Okay. What is the
call you guys?
What's the perfect team look like? What? How diverse do you want your team to be, and in what ways?
It depends on the stage. If you take it at the initial stage, the seed stage of a company, I think a perfect team can be, it's generally not one person, but it's generally 2. It could be as many as 3 or 4, but the skill sets that you see represented would be kind of business sense, product sense, customer sense, and some sensibility about that, whether they have deep experience or they've just kind of learned it, but to see that kind of inspiration around it. The financial side is kind of would be a delighter, but it's I think it's a skill that can be grafted onto the team a little easier than someone who knows product and how to think about building a product, someone who knows how to engage with customers such that you can start recruiting your end target customer, who you think could be an end target customer, to do discovery over their interests, product requirements, that kind of stuff. And then wrapping it all up, it's really just leadership. I mean, you gotta, whether the person's going to be one's going to be long-term CEO or not, someone's got to step up and exert leadership and show it. That to me is kind of the cocktail of a great team. And sometimes I have one of my well-performing companies have one founder, and he just happened to kind of wrap it all together, but he quickly built a good team around him. So.
Well, thank you so much.
Thank you, guys. Thanks for staying awake on a Monday, and I hope the rain stops. We're supposed to get a snowstorm in New York, and I will leave you to the rest of your night.
Thanks so much, David.
Take care. Bye-bye.
You too. Bye.